Okay, we've got a great topic for this video, and it's all about how to trade earnings like a pro. Okay, so trading earnings is this very sensitive topic for a lot of people because a lot of retail traders wrongly believe that trading options over earnings is extremely risky and they're going to get hurt. Okay, I don't get hurt by earnings, like really ever. So there are ways to trade earnings that are insanely profitable that can be done repeatedly every quarter so that your quarter, you have this every quarter, you have this boom of money coming into you because you know how to trade options over earnings. So after this, watching this video, you're going to understand exactly which trades to do and what types of trades to avoid over earnings, because yes, it is risky to trade options over earnings, but the caveat is that's because you're trading the wrong trades. There are the right trades to do. Okay, I have made a significant income from trading options for 8 years now, and I promise you that trading earnings is like really the gravy on top of the fried chicken here, because it's an amazing way to trade. So let's dive into this. You also know probably from watching me for a little while that choosing the right stocks is super imperative to trading earnings. So if you want my stock watch list, it's a graded list of stocks that sort of changes from time to time as stock picks change. You can see the link for that at the bottom in the comments of this video, in the description. Sign up for that. It's great. It's a sheet. It's a living document. It changes over time. So it will evolve. It will continue to evolve, and I update it a lot, okay? So get in on that. So I'm just going to show you really quick a trade that I did this week. So this week we had earnings. I got to shrink myself though, guys, so you can see this. We had earnings on the Magnificent Seven, and that is one of my favorite time periods to trade. Like, love it. I look forward to that date like all quarter long, and it happens 4 times a year. So this is a repeatable little trade that I can do right here. But basically what I did here was I sold some calls on Amazon, and I was able to take in $956 in just 2 days. These contracts are now closed out, so they are no longer exist in my account. This is pocketed cash, okay? I did this on a whole host of stocks that were having earnings this week, and I made money on all of them. And there are like dozens of trades like this in my account. So if you hear me right now, what I am telling you is that I made about $10,000 on earnings, or more than that, in just 2 days. In just 2 days, and these contracts are closed out. So this is a repeatable strategy, and I do it consistently, and I teach how to do this in my Millionaire Mentorship course. So anyway, let's just kind of like go over what we're going to cover off in this video. So earnings, what is it? If you're new, I'm just going to explain what that is. We're going to talk about volatility and this other thing called implied volatility crush, which is what I'm taking advantage of with earnings many times. The risks of trading earnings, the earnings time period, because a lot of people make the mistake of thinking that trading earnings is just about earnings day. It is not. It is about a longer period of time. How pros trade earnings and how retail traders mess it up. Okay, so there's a big difference between how pros look at this versus how retail traders do. Okay, and then a classic winning trade that always wins. Okay, all right, so here we go. Earnings, just explain it to me, Erica. I'm going to. Okay, so earnings happen 4 times a year for companies on the stock market. This is where the company that's on the stock market informs the public of how their sales and spendings went for the last fiscal quarter. Okay, and they have to report this by law because all shareholders have a right to this information, and it's considered public information. So the companies release all the details on their available cash, their debt, their gross sales, their total expenses, as well as many other details. If you're familiar with my stock buying system that I use to choose the best stocks on the market and figure out what those are, You'll notice that I always look at the year over year total gross profits, and then gross revenue, and then their gross profit. And so essentially what we're doing there is that is just 4 months of that all added up into a year. So I like to follow these stocks on a quarterly basis as well, right? So I look at them on a yearly basis, but if I'm trading those stocks, I'm also looking at them on a quarterly basis. And earnings are, those yearly compilations are made from the quarterlies, okay? So a lot of people get into a lot of the details on what are in these statements. I really only care how much money they made and how much money they spent and how much profit they have. For me, that's really all I care about. There may be other people that dig into the details and want to go to the nuance there, and they have a certain thing that works for them there. I don't really care. It doesn't matter to me. The CEO will also lead a conference call for the press, shareholders, and anybody else that wants to listen. I actually do listen to some of these calls because I'm a nerd. I used to love to listen to the NVIDIA ones. The CEO will then also make statements about what they predict the coming market will be for the company as well. So right now we have like this conversation about tariffs that's happening within our world, right? So they might make comments on tariffs. They might make comments on how inflation is affecting them to the negative. They might make comments about how their supply chain is getting easier, so they're going to be able to deliver services faster. All of these things that they say sort of like lead the market to have a reaction. And it's usually that the stock like pumps afterwards or it dumps afterwards. Okay, those are sort of common things that happen there. And that's why the earnings time period is considered so risky, because nobody knows what that CEO is going to say beforehand. Nobody knows what's in those numbers beforehand. And what's really kind of crazy about all this is a lot of times CEOs will give light guidance, meaning they'll say something sort of negative about the company, which even though everything at the company is very positive. This is one of my favorite things that they do. I don't want to complicate this video too much, but I do just want to like mention this for those of you that have been paying attention, or just so you can look out for this in the future. Oftentimes they will give a light guidance and say like, we don't really know what next quarter is going to be like, because they want to set themselves up for lower expectations so that when the next earnings calls comes along, they can blow those expectations out of the water. It's a little bit of a setup. So I love this game that they play. It's very entertaining to me. Okay, so why should you care about earnings? So if you're invested in any stock, you should be paying attention to at least the cliff notes of that earnings call. Okay, like that's something you have to do. Okay. If you can't check in every quarter, you at least have to check in every year, guys. Like if you can't do that work, you probably shouldn't be holding stocks to begin with, and you should be involved in some sort of ETF or something like that. That's my humble opinion. Okay, so my easy way of monitoring this is that I'm just a member of Yahoo Finance. You can get a free account or a paid account. I don't really think it really matters which one you have. Free is good. And then I follow the stocks that I want. I put them on my watch list on Yahoo Finance. And then, the day after earnings, Yahoo Finance just feeds me information about what was in those earnings reports, and I read it in my feed. It's as simple as that. So you will get a waterfall education from reading the articles about those earnings reports after they come out. So I don't expect you to like read the first earnings report ever, or like the cliff notes, the article about it, and understand what the heck is going on there. But if you keep reading it quarter after quarter of about 3 to 4 stocks, you will very quickly start to understand how these earnings reports work and what the reactions to those tend to look like. So if there's bad news, this is another reason why you should care. If there's bad news in that market, you need to be able to decide if the news is bad enough to sell now, or monitor the situation for more clues. So, if they say something in that earnings call about like, oh, we have supply chain issues because there's COVID, right? Like COVID getting worse is not going to be good. Other countries shutting down are not going to be good for that stock. But then you might be able to also see that a month from now, they're announcing that they're opening new factories in other parts of the world that are less affected by something like that. And then you see that as a positive reason to keep the stock. Okay. So like you need to continually sort of be informed if you're wanting to make these investments in these individual companies, or if you're going to options trade them. Super huge if you're going to options trade them. Okay. If there's good news on the call, you're simply riding the stock movement up over time and continuing to monitor those quarterly calls. So if you can't look at these quarterlies, you better look at yearlies. You better understand the story of how that stock is going and what is motivating those sales and that revenue coming in, and then what their expenses sort of look like, okay? Because those are gonna determine overall whether that stock rises or falls over time. That is just the fact of the matter. That is really just the fact of the matter. There are certain exceptions with these meme stocks, but we're not trading that junk. That is junk, okay? We're definitely not trading junk over earnings, like ever. That is gambling. So when we talk about like what not to do, I can tell you right now, do not freaking make trades on meme stocks, especially over earnings. You will get fried. Okay, so volatility is like the real thing that's happening over earnings. An earnings time period is all about volatility. That is what it is. We are capturing the benefits of trading volatility. Earnings time periods are high volatility times. Okay, so as traders, we capture movements in the stock for profits to the upside or the downside. That's what we can do. So in other words, we use volatility to create profits for ourselves. Volatility is extremely high around earnings, with the height of volatility coming in the day of or the day before earnings. So did you notice on that trade I just did? I did those trades like 2 hours before the earnings call. All of them, all like 12 of them that I did, that I took home like $10,000 in 2 hours or an hour or something like that, okay? Volatility grows in the stock 2 weeks before earnings. And this is very awesome for options traders because that means the premiums that we're looking for, that premium that I got paid, where I got paid $950 or something like that, that was higher than it would normally be by about 20 to 30%. So that's huge. So premiums are high the day of earnings, okay? And they are higher than normal 2 weeks going into earnings, okay? So volatility, what does it mean for traders? Since premiums are high at highs the weeks before earnings, and we know that earnings happen 4 times a year, this leaves us with a predictable time frame. We can trade 4 times a year, okay? It can be highly profitable because the premiums are 20 to 30% higher than other time periods. And because of this, some traders believe this is an extremely risky time to trade. All right. So why is trading earnings risky? If I'm going to say like, hey, I know it's not risky on certain trades, we have to sort of like examine why so many people are claiming that it is risky. And I also want to agree with them that, again, trading earnings can be extremely risky. It just depends on the trade that you're going to do. So why is trading earnings risky overall? Why is that the general consensus? Nobody knows what's inside that earnings report. And we'll get into like which trades are risky in just a minute. There's got a note there, but the news could be good and it could be bad. And because we don't know that news, that's what makes the stock volatile. What you may not know is that the other reason for volatility is that option contracts are bought and sold to add to the volatility of the stock price. So you've got like this situation, you guys may not know this. If you're new or to the stock market, you may not know that like there are more options traded in a day than orders for shares. Is that wild or what? Because there's some people who go like, well, I mean, if options are so big and so profitable, how come everybody's not doing it? I will make a video about that at one point in time because that's super interesting. But what you need to understand is that there are institutional traders that are trading insane volumes of options, and those options move the stock price. So if there are like a lot of puts on a stock, it will push the stock price down. If there are a lot of calls on a stock, it will push this price up. Okay? So what happens during earnings is that there are all these institutions that are trading options in higher volume because they know there's more premium there to get, and they take advantage of that. So they're even creating more profit for themselves by creating more volatility. It's insane, like the amount of wealth that these people at the top can create for themselves. And what I'm trying to do is say, hey guys, this is going on. Why don't you do it too? Like I do it. Just because I know these patterns and I can play these patterns and I can share this with you. Okay. So all the big traders love to trade earnings. And they've sort of convinced, a lot of people out there that, hey, you maybe shouldn't because you don't know what you're doing and you're not smart enough to get it. Okay, so they go into this time period with confidence, and retail traders don't. They're scared. They're pretty much scared, and they're only scared because they just don't have an education. And guess who does have an education? The guys at the top. And they're mostly guys, I'll be honest. They're mostly guys. They're hardly any girls. By the way, if you are a woman, geez Louise, educate yourself about this. This is such an amazing thing to do part-time for an income stream. I know you're busy. I know we're busier than guys, okay? I just know we are. So you should be doing options trading to capitalize on that, on your income. Okay, so why is trading earnings not risky? Okay, the reason trading earnings is not risky is because there are many trades to choose from that went no matter what the outcome of the stock is after the earnings. Okay? Pro traders know these trades. Retail traders don't know these trades. And it's only because retail traders lack an education that they can easily get. If you can identify the trades that will make you money no matter what, you can take advantage of this time period 4 times a year and walk away with stacks of cash. That's as simple as that, okay? So what are the trades? Of course you want to know that, but first let's talk about what you don't know. And you also don't know that you don't know it. I love that. Okay, so trading earnings day is not about earnings day. I'll say that again. Earnings is a larger time period than you think. It's actually about the 3 weeks before earnings and the 1 to 2 weeks after the earnings call. Okay, so pro traders identify patterns in their favorite stock before this time period and simply play that time period with options trades that match it. So one of the reasons I am a fan of trading something like 2 to 3 stocks, if you have a smaller account, or or if you're new to trading options, or 5 to 6 stocks if you have a larger account and you have experience with trading options, is because you can start to identify these patterns yourself, and taking advantage of those patterns is where you make a lot of money. You don't make a lot of money trading a lot of stocks because it's very difficult to understand the patterns, but you only need to know patterns of 3 stocks to make a freaking killing. Okay, that's all you need to know. Pro traders also think way ahead in time frame. Since pro traders recognize earnings is actually a 4 to 5 week time period and not a single day, what do? They plan way ahead. They plan their trades. Like some of you guys just walk into your computer in the morning, you're like, oh, I'm going to trade options. I'm going to try to see what's out there. Guess what? There are people that do not trade that way. The pro traders do not trade that way. They plan in advance. Me, I know the trades that I am placing, at least 50% of them, okay, a month before they happen. A month before I place them. I'm already preparing my portfolio for trading the next month. That seems wild to a lot of you because you're like, what? Well, yes, that's what I'm doing. And I'm planning around earnings time period to be able to take home some sweet, easy money of those time periods. That's one thing I'm planning for. The other thing I'm planning for is seasonality. I'll do a video on that later as well. So just like if you were building a house and you would need that lumber to get there 2 weeks before you want to start hammering it together to frame out your house, and you know that plumbing material better get there as soon as you're done with the framing so you can move into sort of like plumbing and electrical. So you buy that a month and ahead if you were building a house, right? So these things would come in stages. Pro traders plan their trades out that way too, a month in advance. So do I. So do you guys see that analogy? That's how they do it. That's how they do it. And that's what makes it safe, is because they're using a longer time period. Okay, so trading, again, earnings is not about trading earnings day. Pro traders are planning their trades. We've established that, but they aren't psychic. So how do they know what to do? Okay. A lot of stocks have a tendency to rise at predictable times and decrease at predictable times in this 5-week window. And a lot of stocks do these patterns sort of like 3 times out of 4. And if you know anything about returns on the stock market, if you can predict what's going to happen or trade in alignment with something that's going to happen 75% of the time, you can make an absolute killing. It doesn't even matter if you're wrong 25% of the time, because 75% is such an insanely good win rate, and the wins are so high, and you can sort of protect yourself on the losses that this is just sort of like a winning formula. So if you're an advanced options trader, you know exactly what trades you can also pair with those predictable stock movements. Okay, so you have to be an advanced trader to understand this. Like the covered call is going to work here. The cash secured put is going to work here a little bit. But there are so many more advanced trades that get far, far, far better earnings and far better money in the pocket than those trades on this. And they know those trades. So what pro traders do is they look for patterns. They just look for patterns and then they play those patterns. Okay. So the other thing that they do is they are trading implied volatility. So there is volatility in the market, but then there is also this thing called implied volatility. And implied volatility means that we all agree that no one knows what's going to happen in this stock thing next. So we all agree that these contracts are worth more right now, right? Like we all say, hey, there's more risk on the table. So we are just all in agreement that we should get paid more to enter the market right now, okay? Earnings trades take advantage of implied volatility, okay? So pro traders know that they can get paid to carry shares and options during this time period, and they pair great stock picks with time frames to make a ton of money collecting premium for the risk they've put out that they don't see as a risk because they know the right trades to pair with it. A lot of retail traders don't. The thing is, they know their risk is quite small because they pre-plan the math. Retail traders don't take the time to do this. They just see the trade and they're like, oh, I think I'll take that trade because I think that Amazon's going to do well for earnings. And so I'm going to do this because that matches to a good earnings call. And they didn't do the math in advance to figure out what would happen on the upside and what would happen on the downside. And they didn't figure out a protective layer to that either. Retail traders tend to react on gut instincts, which is a terrible idea and has absolutely no discipline. To be honest with you, it has no discipline. It has no math. It has no thought strategy. It has a little bit of strategy, but a lot of it is based on hunches and feelings. And feelings aren't real. Money is real. Stock movement is real. When it actually happens, that's reality. But they don't trade that way. They don't take the time to do the math in advance. Where if you sit there and you talk about some pro traders, they're sitting there actually doing the math, adding up how many contracts they could buy, what a 20% move would be, what the premium would be that they could collect, and they're deciding if that is worth the risk profile or not. You guys aren't doing that, I guarantee it. Okay, so implied trade, the other thing that we are doing when we trade earnings and that pro traders are doing is that they're trading implied volatility crush. This is like one of my favorite phrases on the market and something that I just took advantage of in that example trade that I show you. So there's a yin and yang on the stock market. If one thing happens, another thing must also happen. Okay, so once the stock's earnings are released, all the risk is now off the table. It's just gone because everybody likes cats out of the bag. We all know what the secrets were that were in those earnings reports. Therefore, as soon as that earnings call is out, the volatility goes down dramatically most of the time. This is another reason why earnings calls are usually right after the market closes, is because there's just this drastic change in volatility that happens, and they don't, like, we're not really supposed to be trading that. Like, it's set up so that we don't trade that action, okay? Because it all like gets done in overnight trading, which is kind of a really interesting thing. So this drastic movement from high volatility to low volatility is called implied volatility crush, okay? Pro traders know they can get paid so much money the weeks before earnings because they're getting paid higher premiums then, and then they can just close those trades out as soon as the implied volatility crush happens right after the earnings calls. So it's all about timing and planning. You have to plan taking advantage of the premium you could collect because of implied volatility, and then you have to plan how much you can lock in on the implied volatility crush. So that's what they do. And that's what I do too. And I love it. It's my favorite. So pro traders don't gamble. We've all seen other YouTubers or trading gurus buy calls because they just know the stock is going to rocket on earnings. Okay. And this is bullshit. There's like, do not do this. This is insane. This is gambling. It's also greedy. Great stocks often do not rocket after earnings. They often sell off. Like, you can have, it's the wildest thing to watch the Magnificent Seven earnings, because what ends up happening is like Microsoft will, okay, this happened this week. All right. This just happened. Go look it up. Microsoft had amazing earnings, amazing. Stock soared. Meta, amazing earnings, stock soared. Apple, Amazon, stocks had amazing earnings. Amazon dumped, Apple stayed the same. What is that? What is that? You are all going like, what is it? Go look it up. Go look it up right now. Today is Friday, August 1st, 2025. Go look it up. Okay. So the reason you can't make those kinds of plays on buying calls is because great earnings calls do not result in stock upside all the time. So that is just a stupid idea. It's a stupid idea. Like, pro traders know, great traders know that they can't gamble like that. Or if they're going to, they're doing it with a very small amount of cash. Okay. They know the stock can sell off. So they make trades that are going to win no matter what. You guys are like, what the hell are those trades? Okay. So, what's the trade that will win? If you've seen my covered call videos here on YouTube, you've seen like, I love the covered call. You guys, the covered call is such a beautiful trade for earnings. Have you ever considered selling a covered call on shares you would be willing to say goodbye to before the earnings call? Because you would get higher premium than selling that call at any other time, often 20 to 30% more. So I'm introducing this trade to you just to get your mind percolating here. So like, if you have always thought, oh, trading earnings is so risky, I'm not going to do it. Look at what I just showed you. Go back and watch the video again if you need clarification. But those premiums are going to be 20 to 30% more. So why would you sell a covered call at the beginning of the month in July when, for a month-long time period, when you can just wait till the end of July and sell that call for 30 to 20% more? Okay, so if you've watched this video and nosed around other videos on my YouTube and sort of thought to yourself, hey, this Erica chick, she kind of like thinks of some stuff that I hadn't really thought of before, and you're learning some stuff, there's just so much more where that came from. So in my Millionaire Mentorship Program, we do so much more around earnings. Like, I gave you one idea on how to trade that, but there's so many more plays you can make. There's so much more money to be made to take advantage of volatility and just line our pockets and change our lives. That's what I've done. And your life could be next. So like, if you want to learn more about this, you're ready to level up your options game and really get serious about it, book a call. There is a meeting in the link below. Please be serious. If you're going to take up an hour with me or half an hour with me, please be serious. This is something that you really want to consider and do and level up, because you know that you want to take advantage of really top level information and get your income to new heights.